Hello, everybody. Thank you guys very much for coming out on on an evening to get educated on different real estate investments. My name is Matthew Owens. I'm a California licensed CPA and a full-time real estate investor. I love doing what I do and teaching other people how to invest in real estate. And there's a lot of different intricacies. I get questions all the time on, should I be flipping or should I be holding, and do I need do I need capital in order to hold in the first place? And what strategies can I use when trying to hold right out of the gate without any capital? What strategies can I use to flip properties? And so I thought it was a very good topic, or a very hot topic to discuss. And so I wanted to have this webinar tonight to go over with you some of the different strategies that I utilize, as well as you can utilize when you're actually flipping properties or trying to hold properties, and some of the ins and outs of the different investment options that you can work within. It's always a pull back and forth. Should I be a wholesaler? Should I go and be a fix and flipper? Should I buy multifamily? Should I invest in single family homes on a consistent basis? Which is the right direction to take? And there's no set answer for that. There's pros and cons for these different avenues of investing, and I'll go over some of those different strategies throughout the presentation tonight, and hopefully get out of here right on time with you guys, so that you can enjoy the rest of your evening. So that being said, I want to go over some of the topics that we're going to be discussing today. So we're going to, like I mentioned, we're going to go over some of the pros and cons of flipping and holding, some of the different types of flipping that you can do, and types of buy and holds, the problems that arise with these different aspects, the due diligence that you should be doing when you're flipping or when you're holding or when you're buying multifamily buildings. There's definitely a lot of differences there. One thing that I think is very, very key in understanding is understanding the entire flow of a transition from your initial due diligence phase through the acquisition process and renovation process. So kind of lining that out in detail so that you can understand that aspect, as well as the team members that are needed to deal with each aspect of a flip and each aspect of a hold, because there's definitely different team members involved in different quirks with the different types. So also the closing escrow and understanding that process, there's some differences there. So you don't really learn these strategies unless you're involved in it on a consistent basis and doing it over and over again. So understanding the closing process, what fees are involved, and things like that is very, very important. Also managing your investment on a consistent basis. I went through a lot of learning curve initially on how to manage an investment, what investment types to buy, which ones not to buy. Throughout my career doing this, you learn the hard way a lot of the times on what to do and what not to do. So, and then I also have some examples to show you guys where I break down the numbers associated with this stuff so that you can really get a good feel for the overall investment types that exist, and the numbers to look out for when you're flipping a property or holding a property, and what to pay attention to. So we'll go over all of these different options tonight. To give you a little background on myself, I am, like I mentioned, I'm a CPA. I've purchased over 450 houses. That's probably actually greater than 500 now. I just haven't done the math in a little while. And we're buying about 5 houses per month. I've raised quite a bit of capital over my investment career, over $35 million in dollars. I am constantly raising about $300,000 to $500,000 a month for different investments from outside investors, as well as dealing with reoccurring capital. I also manage a 200-unit property portfolio out in the Memphis market. I have outside management and in-house management to retain control over different facets, and that's on the multifamily and single-family home side. I buy primarily, a multifamily, a couple of them a year, as well as these single family homes that are very cookie cutter for me, that we have a consistent process doing. And owning the renovation and management company to retain that control is very, very key. We went through a lot of headaches with previous management companies and previous contractors not doing their job or not managing a property effectively. So understanding and controlling the renovation and the management is very, very key to your success. And I would suggest, whether you're flipping or holding, to really understand the management aspects of the renovation and what should be occurring versus what contractors tell you. And then same thing on the management side. What should be occurring? What information should you be getting? What should be the processes and procedures of a management company that's efficient versus inefficient? So that's very, very important. I actually went to UC Santa Barbara and graduated with a degree in economics with an emphasis in accounting. And in the beginning, I actually wanted to become an architect, but they didn't have architecture school at Santa Barbara, and it was too fun of a school to actually to leave. It was right on the beach. I wasn't really going anywhere. It was a great experience. I specialize in real estate taxation, the commercial and residential investment analysis, helping other investors out on their legal and tax structuring and property management and overall investment analysis. And I bring a lot of resources to the table with regard to lending and understanding different syndicated investments that I invest in myself as well. So I help a lot of investors through their own investment goals and what they're trying to accomplish, and really point them in the right direction with regard to what's going to hit their goals and what's going to hit their overall cash flow and financial goals. So my accounting experience, I actually worked for, before jumping into real estate about 9 years ago, I actually worked for a couple of CPA firms where I would do tax and audit for some very large real estate companies as well as other companies, and got to see the inner workings of very large apartment buildings and all the numbers associated with those. And I would help companies with their internal controls, reduce fraud risk factors, help them with their bottom lines, and realized that I was sitting on the wrong side of the table watching them make all this money in real estate and not getting involved myself. So I actually got educated, took some different real estate classes, and jumped in, full boat with my first flip, where I was going to make about 30,000 bucks on the flip, and decided that's it. I need to go for this and do it full time. This is I was very passionate about it, very interested in real estate, and love the passive cash flow element of this, of understanding that if once you get all of your company or all of your monthly living expenses covered with cash flow, true financial freedom could exist. So that being said, a little bit more about what we do here is we buy single family and multifamily real estate and invest in other types of assets like promissory notes and syndications that are run by professional outside operators that specialize in their field. We also find ways of increasing value through the renovation. On the single family home side, it's pretty simple. You buy a property under market value, renovate it, and then you have built-in value there as long as you purchased it correctly, and then you rent it out for cash flow or resell it on the open market, or rent it out and then resell it on the market as well. So there is a demand for cash flow properties out there that it's pretty interesting, so that people can retire. We also do, I specialize in providing that passive cash flow for ourselves as well as our investors through joint ventures, through direct sales, through different facets and multifamilies and things like that. And we add this value to these multifamilies by increasing rents and finding ways of increasing cash flow, which increases the return on investment. We also do a lot of those support services that I mentioned, talking with investors and helping them with, the tax planning and their goal structuring, and the entity structuring is really important. A lot of attorneys immediately tell investors to open up entities right away, which it's not always the best strategy to utilize. You want to find assets first before necessarily opening up all these entities to invest in. It doesn't make sense to open an entity when you haven't necessarily bought an asset yet or started investing yet. You're not really protecting anything. You're kind of wasting money on an annual basis. We also do bookkeeping. My wife is a QuickBooks Pro advisor. She has her own bookkeeping practice. She deals with a lot of my investors' bookkeeping aspects of things, and really helps them on a consistent basis keep things up to date. Whether you are working with us or not, or working on your own, it's imperative that you keep your books up to date and understand your cash flows, what's going in and out every month, understanding exactly what your monthly expenses are, because without that, you don't know what you're trying to cover in cash flow. You don't know what your goals really are going to be. So that being said, let's talk about that really quick, the actual true goal. I mean, whether we're flipping or we're flipping so that we can get enough money so that we can invest it to be able to get enough cash flow to retire. Nobody wants to necessarily have to work full time. If we can cover all of our monthly living expenses with cash flow, then that's the primary goal. And so that includes, you know, all of your normal expenses that I've listed here, as well as savings, as well as adjustments for inflation, because we see a ton of inflation happening, and kids and future expenses like cars and traveling and things like that, to allocate a portion of that on a monthly basis so you can go do those things, because those things happen and you don't want to not allocate for them. So if you come up with a budget where you have your monthly expenses and they equal about $8,000 a month, you want to be able to have cash flow from your investments, or a goal in that realm of $12,500 a month or more, so that you can compensate for the inflation factor here, because that difference, you need to be able to take that money and invest it into more and more cash flow to keep up with inflation on a consistent basis. So you want to be able to continue that stream, and you know, hopefully you're producing above inflationary returns, which is really important. You know, they say it's 3%. It's typically higher than that if you adjust inflation for some of the changes that they've made to the number to make it look better. You know, so these are some of the things that you want to watch out for. Now, you know, making $12,500 a month may not be, you know, sound like the easiest thing in the world to do on a consistent basis. That's a lot of money annually to do that. And a lot of people kind of get stuck and dead in the water, where they don't necessarily know what to do to get to that point, or how to get started. Maybe they have 50 grand or $25,000 and they don't know really where to get started, or they have a couple $100,000, which isn't enough to get to your $12,500 a month goal. So I'm going to break it down for you. The way you can structure this is very, very key. If you're using your money and you are going to make 10% on your money, that's $150K a year, or your $12,500. So unless you got $1.5 million sitting in the bank and you can make 10% on your money, then you are not going to be able to hit your 12.5 goal. Same thing with, you know, if you're going to make 8%, you need 1.875 million, which sounds like a tough thing. And honestly, if you're flipping, trying to get to that level, it may take you a good chunk of time to get to that level. And really be able to succeed at doing this. But if you're utilizing other people's money, or OPM, it's really a lot simpler than you may think. If you can make 4% on that money, on $3.75 million, you could hit your $12,500 goal. So the trick, though, in utilizing other people's money to do this is to be able to understand how the risks work and how the paperwork works, and how to educate other people and educate yourself on how to do this where you're protecting your investors' capital. So one of the most important things you can do as an investor is always, always, always protect your investors' capital. So I'm showing here, if you can make a 2% spread on $7.5 million, you hit your goal, or 3.75 million to hit your goal. And you can couple that with your own money. So if you were to make 25 grand a flip, it would take you 60 flips to get to that $1.5 million goal on that aspect. So, you know, keep all this in mind. There's different ways of utilizing these funds. And in the beginning, when I first got started, I didn't know how to raise $30,000. I didn't know anybody with any capital or what to do. And I had to slowly educate myself along the way so that I could have the possibility of being able to raise these types of funds. Now, I've raised tons of money over the last 9 years, and you can see it's taken me some time to get to the point where I've raised over $35 million for different clients, for different investments. But over time, networking, understanding how investments work, understanding where the risks are, is what gets you to that end goal in mind, okay? So, and you can do that through a lot of different methods, through multifamilies, private financing, joint ventures, syndications. There's a lot of strategies you can utilize. So let's get right into it. So now that we understand what the goal is, let's talk about some of the pros and cons to flipping and on a consistent basis, so you can understand what the differences are. So On the pro side, we have a lot of pros with flipping. Obviously, the biggest one, faster profits, cash infusions. They can be great strategies for building up your capital very, very quickly. And being able to do that is important. Now, keep in mind there's downside risk on those types of investments too. So we'll go over that in some of the cons. They're less susceptible to market fluctuations because you're in and out in a very short period of time, as long as you're very good on your construction time and things like that. Your capital's tied up for a short period of time, so you're not paying really, really high interest as far as because of the short period. You don't have tenant headaches to deal with. There's typically a higher return because you're getting these chunks of cash in very, very quickly. But it's very active of an investment. This is not a passive type deal. So you want to look at active investment return on investment versus passive investment return on investment so that you can gain an understanding of what to expect on an active side and what to expect on a passive side as far as return. It's easy to raise other people's money on flips because there's professional lenders out there that will specifically lend to you. Now, if you use hard money or hard money rates on those things, it's very hard to make a profit on those deals because they eat up a lot of the profit in there, and you need to build those costs in. And it's kind of a sexy investment, I'd say, because it's all over the news. You tell people you flipped a house. It's easier to raise capital that way. You have more interest and things like that. So from these different investors. So having that scenario of, hey, I'm flipping houses, you get a lot more interest from friends and relatives and other people that might be interested in funding you. And you can get a lot of reinvestment capital. So people will fund you over and over again once you've shown performance. But you have to learn those renovations, the property sales, the deal analysis, and you're going to make a ton of little mistakes. In the beginning, it took me so much time to learn all the little costs that seem to come out of nowhere on a flip project or a hold project. You don't realize the different costs that are involved there. Let's look at the cons. So there's high carrying costs, usually on high interest loans. So when you have on a monthly basis, if you have run over on your construction, your carrying costs are really significant. So they can cost you a lot of money, especially on a $600,000 house here in California. If you're paying a 12% interest rate or a 10% interest rate to somebody to be able to borrow those funds, those things really add up. And so you want to make sure that even if things take a lot longer than expected to sell, that you're in a good position and you're adding some buffer time there, because contractors can go over, especially if you don't have the experience with that contractor. So we put construction contracts in place with timing requirements with regard to all of that. So the transaction costs are high. You have in and out where you're doing closings on two sides of the things, and you have seller commissions that you have to pay and things like that. Other contractor issues like not buying the right materials, leaving your job to find another job, and costing you time. And so a lot of times also when you're dealing with sales to homeowners, sometimes you have these quick closings or quick turnaround time, on the back end when you're dealing with financing. But then on the front end too, if you don't close quickly and get those funds, it's a scary situation because it's always the catch-22. How do you find the money without finding the property, and how do you find the property without having the money readily available with proof of funds to be able to show that lender? And so lining up your funding sources is really, really key and important when you're looking at different projects to possibly invest. And you have a very, very time-sensitive situation because every moment that it's vacant or sitting there, it's costing you money on a consistent basis. You also have code enforcement and utility costs. So a lot of times utility companies and code enforcement will cost you a ton of time, like a month even, or a month and a half sometimes, to get things permitted, to get utility companies to sign off and turn your utilities on when they've been off for 3 or 4 months because of foreclosure or something along those lines. So there are some specific hoops to jump through when you're dealing with these different facets. like I mentioned, higher interest on the money, and you're going to be paying short-term capital gains in most cases on a flip. And so you have to consider your tax implications on each flip to make sure that you're allocating the right tax withholding for these, to make sure you don't get caught at the end of the year with doing a couple flips and then thinking you have more money than you do and then getting hit with this. I know some flippers that will wait 1 year and then sell the property as well, or they'll rent it for a couple years and then resell. So there's different strategies depending on how much active income you have to invest. And so here's an example of a deal that I did that was a dud. Okay, I'm not showing you the home run, of course, but I bought this house for $59,000. Okay, this is a high-end house. It's over a 2,000 square foot house in a great area, but it needed a bunch of work. It needed $26,500 worth of work to it, which sounds like a lot out in the California market, but this is in Memphis, Tennessee, where the value of the property is actually close to 130. And so I went through and sold this property. I had closing costs, appraisal, inspection, utilities and purchase and permits for a couple thousand. I had interest. I had actually right after I bought this house, the day after, when I had already had an inspection and everything was fine, the foundation cracked in half. And it cost me an extra $16,500. So that's a huge loss, where there goes all of my profit on this project right there from the foundation cracking in half. And so I had some rental income after I rented it, and it took me a little bit more time to actually get this property sold because of the foundation issues and things like that that occurred on it. And so I actually made a profit of $1,125, and it took 9 months to make $1,000. So, this is a great example of the types of things that can happen when you flip a property, and the types of issues that can come up when you're dealing with that. Now, it was a giant headache, and it was scary to get that done, of course, when that happened. But when I'm doing 5 a month, I can deal with a hit like this and not worry about it, especially if I'm at least break even or making a little bit of money on the deal. Let's go into a little bit of the hold scenarios here, and I'll kind of talk about this picture up on the right afterwards. That is my home run here, hit here, which this used to be a tree, and we'll talk about that in a second. So let's talk about the kind of the positives of holding property. So we're looking at an inflation hedge, which is huge, especially when you're dealing with financing. You can finance a property, put 25% down or 20% down. Over time, that loan payment actually feels like less and less and less of a loan payment over time as inflation occurs, while rents consistently rise or will rise over the long-term period of time. At the same time, the property value also will rise over time. It's not really values of the property rising, but it's the currency declining in value over that time. So you actually have that inflation hedge in your mortgage payment, in your rent amounts, as well as your values of those properties, which is a great strategy to use versus paper assets or promissory notes and things like that that are not necessarily inflation hedges. There's less work than a flip. Once you have it up and running and done, you kind of sit and hold it and let the manager manage it, and you just manage the managers. Now that can be a headache sometimes, but it's a lot less work in the long run. And it's great for that long-term wealth building and that cash flow. The whole goal is cash flow. So if you buy one house and you're making $300 a month off of that, then you can say, hey, my cell phone and cable bill is covered now. And you slowly allocate these pieces of cash flow towards your individual expenses, so you can have individual little wins along the way, and find ways of slowly covering each and every expense with cash flow in one way, shape, or form. There's some great ways to force appreciation as well. Like I mentioned, through the multifamily properties, increasing rents by rehabbing properties can be a great strategy to utilize. We do a really high-end job on our renovations on our single-family homes too, which increases the rent amount by 50 to $100 a month compared to market, because we do such a great job on our renovation. So it can be a great strategy to utilize and realize, hey, if I get an extra 50 or $100 a month for incurring an extra $500 in cost, or an extra $1,000 in cost, is it worth it? What's my return on investment on those little changes that you can make along the way? You can, like I mentioned, the exponential growth, you get some great tax benefits through depreciation. Now, most of the depreciation benefits out in the Tennessee market that I do most of my business in, you get an 80% building portion and you get a 20% land portion. So through that strategy, you have some great tax benefits associated with it. Property management can be key and set up to manage your assets, and you don't have to sell immediately. If it's positive cash flow, no matter what the market does, you have potential on the upside and downside potential on that property. Let's go over some of the cons. So it can be a management intensive when you're managing managers. If you don't have a good manager, it's imperative to find a new one that's doing a really good job. Preventative maintenance is very important to make sure you do all that preventative maintenance up front so you can understand what problems exist and what things to allocate a specific level of cash flow for on a monthly basis out of your return on investment to cover those types of costs. There's always tenant turnover risk, which can cost you money. And you want to basically make sure you get a good enough security deposit to help cover some of those costs. There's some liability owning property, so having a good insurance policy in place or the right legal structure is important. It can be costly to keep up some of those entities, so decreasing some of your entities can be key. So you're always weighing the cost of entities versus the cost of keeping those entities and actually doing different tax returns and bookkeeping and the annual fees associated with the entities. So I talked about the property management and how important that is. Lending can be a little bit difficult because you have to jump through hoops and providing a lot of information now. You have tenant legal issues. What if they sue you, or there's theft or damage to the property? So all those things are definite concerns, and there's ways to mitigate those different risks involved through entities, through insurance, through doing all the right procedures with your tenants and having a good manager in place. And there's always buying in the bad neighborhoods. You don't want to buy in low-end areas. Here is a property that this is what the tree looked like in the inn in the top right. We had this literally gigantic tree fall on one of our houses, and actually it cost us about $60,000 to rebuild the house from where it was and reframe and things like that. And the insurance company paid us like $147,000, so it was a home run win on this thing. Now we had some loss of rents. We had we had to pay for a hotel for the tenant for a period of time for about 6 months while we fixed it all up. But it was a good win-win once it was the end of the day. The tenant didn't have to pay rent for a period of time. They got free stay at one of those nicer hotels for a period of time too. So even though it was an inconvenience for them, we made it worth their while. Let's get into the types of flipping. So, and I'm speeding through this because I realized that I've spent about half an hour already on these slides, and we're on slide 8. So I want to get through some of these different strategies so you understand them in more detail and understand some of the numbers involved. So single family home fix and flip, they're short term in nature. There's a competitive market there, and it's easy to finance with fast profits. So very, very strategic. Now, if you're flipping a multifamily, you're dealing with a little bit longer of a term. You have to show performance of that building so that whoever's buying it from you can actually go get a bank loan based on the operations of that property. It's a little bit less competitive. It's a little harder to finance because you're dealing with commercial lenders, but they're looking at the property, and there's specific hoops to jump through on that financing side. And there's usually not 30-year amortizations. There's 20 to 25-year amortizations on those types of things, but there's some great value add potential in forcing the appreciation, and I'll show an example for you in a second. You can also do wholesaling, mobile homes, land, flipping notes, flipping seller finance properties, and things like that. There's a number of strategies you can utilize whenever you're investing. Here's a deal that I did on a single family home. I bought it for $87,000. My all-in cost after rehab was $112,000, and I sold it for $140,000 and made a $28,000 profit in 9 days. I actually sold it before the renovation was done and then finished the renovation after they had already purchased the property. So great flip on this in this scenario. This scenario here, I have a 30-unit building that my all-in cost is $1,065,000. I bought it for 780 grand, put about 265,000 into it. The reason I have interest and rental income here is because they pretty much canceled each other out. I borrowed money at a higher interest rate and then basically put all that extra capital right into the property as far as renovation costs. But now it rents for $17,000 plus a month. My net rents after everything are $8,800 a month. At an 8 cap, it's worth $1.32 million. And the profit, if I wanted to sell it now, I'd make $160,000. But I took rents from an average of $491 a month up to $650 a month, which increased my annual cash flow by about $52,000 a year. And at an 8 cap, that increased the value by about $658,000 on my cost. So very, very interesting scenario. Here's actually the building, what we did to it. We redid all of the outside walkways, the whole exterior of the property, all the interiors of the property as well. It looks amazing now. It's a great long-term hold. I'm holding this one long-term. We're refinancing for a long-term bank loan. Here's an example of a seller finance flip. So this is an 1,800 square foot house, 3-bedroom, 2.5 bath. The rent's for $1,100 a month, okay? I know the rents out in Tennessee are crazy when you start doing these numbers, but the prices are commensurate for it. So I bought it for $78,000. I put about $17,000 into it. And my total cost is about $106,000 or $107,000. So if I sold it for all cash, I'd make about $18,200 after sales costs. Okay. If I wanted to go and sell it with seller financing with 50% down or 62.5 down, which is actually relatively easy because there's a lot of international clients, a lot of clients that invest with their self-directed retirement account that can't get traditional bank financing. So if I loan them the money, the 62.5, and I let them put 62.5 down, I'd finance them the deal at 8% over 15 years, a fully amortized over 15 years, but with a balloon payment due at the end of 7 years. And my monthly payment on that would be $597,000 or $597 a month. And they'd owe me a $42,000 balloon at the end of the 7 years. But my net capital in the deal after the down payment is $44,000. So that's a 15.81% return on investment for me on my money. If I'm collecting $597 a month for 7 years and then getting my balloon payment on my $44,000, it's a great return on investment. So keep that in mind when you're selling properties. If you have capital to leave in these deals, it's a great strategy to utilize to keep the profits involved in your promissory note and then hold it long term and be able to generate a great cash flow return on investment. So the types of buy and holds that you can do, okay? So let's talk, we have cash, bank financing, private financing. You can take a property over subject to the existing financing that's in place, like from a homeowner that might be underwater, but you can make it positive cash flow on a monthly basis. Lease options, joint ventures are all great strategies to utilize. On the multifamily, you can get a mix of the equity and the financing from a bank. You can get construction loans. You can do syndications, whereas pooling private investors' capital together to invest in different assets. You can force the appreciation with them, refinance them after you've forced that appreciation and really be into it for a very low amount of money. And you can do different joint ventures. And so there's also other types of buy and holds like lease options or leasing property long term and doing that type of strategy where you're actually making a spread by subleasing property, fixing and holding properties from short-term debt to long-term debt, seller financing properties and collect and buying those with seller financing already attached to them, or investing in different notes. Okay. So here's an example of a property where I bought it for $175,000. My all-in cost is $199,500. With a 20% down payment or 40 grand in closing costs, the total out of pocket is about $46,000. And the net monthly rents are $1,356. The mortgage payment is $833 a month. So we're netting $523 a month on this deal with another $2,500 a year in principal reduction in year one, at least. It goes up slowly over time. And then, so that's about a 13.64% cash flow return, and then a total return on investment of about 19% if you include the principal reduction on the loan. So there's some great strategies to utilize here. Now, if you're buying this all cash for 199.5, that's about an 8.16% return on investment. If you're buying with private financing and putting a little bit more down when you're dealing with private financing, so call it about 70 grand, you can make and paying them an 8% interest rate instead of 4.75%, you're looking at about an 865 payment and about an 8.44% return on investment. So you can utilize other people's money and pay them a good return on investment and still be able to make money on acquiring these different assets. Okay. So this is an example of one of my multifamilies that I just recently did. It's 12 units. They're studios and one bedrooms, even though they're really one bedrooms and studios, or one bedroom and two bedrooms. They don't have closets in one of the rooms, so I can't classify it that way. But it's in one of the best areas of Memphis, right in the Midtown area, right in the middle of everything, very trendy area. It rents for $9,195 a month. And my joint venture investment price is $895, and if someone wants to buy it from me outright, it's at $985. And so that's a 9% plus cash flow return, and then an 11% plus cash flow and principal reduction return on a multifamily building that's that's going to create a great return on investment for an investor. And we've done everything to this building, from going through and doing the roof, the foundation, the plumbing, all windows and doors completely redone, including the framing, all of the plumbing, all of the electrical, all the kitchens and bathrooms completely refurbished, including the decks and everything else, and new AC units and all that stuff. So this is a fully up and running, performing property with all the preventative maintenance done with it. So great value add type asset that we did. So let's go over some of the problems here, okay? The fun stuff to deal with. Construction overages. Always, always, always put rehab buffers in place on your deals. Time is your enemy, absolutely. Holding costs are high, of course. The market fluctuations can kill you. So especially in this market, you don't want, in California, you don't want a really, really long-term type flip, because the market fluctuates a lot more here comparative to like a Tennessee market that I invest, where we don't have very much fluctuation. On average, it goes up about 4% a year, and then when it crashes, it goes down by about 2 to 4%. So much more stable market to do flips in. And dealing with contractors, like I mentioned, can be headaches. The high cost of capital, the city and utility companies, lending to your buyer can be, important, and understanding with your buyer on the back end side, can they get these loans and are they qualified? People fall out of escrow all the time because the lending falls apart. The taxes are a big problem. When you're dealing with holding properties, you have property management issues, tenant evictions and damage from them, preventative maintenance costs, local market changes, like what are the tax and legal implications in those market, tenant turnover, theft and crime, natural disasters and weather. These are all different things that you want to find ways of mitigating, but there are absolutely ways on the flipping and holding side to stop any issues that come up from this, okay? And that comes from the due diligence aspect of things, okay? What you're going to do is understand the neighborhood, the market value analysis, the rental analysis and renovation, understanding all of your different numbers within your closing documents and your cash flow and return on investment, understanding what your insurance covers and does not cover. So not all insurance companies are created equal. So it's very, very important to understand what your insurance covers and doesn't. Property management as well, very, very key. So I tell people, do not invest in the lower end neighborhoods. You see a lot of these types of cars where the rims are more expensive than the cars in those low end neighborhoods. And you got bars on the windows that are not the aesthetically pleasing type bars for viewing purposes, So and you want to stay away from the rural type areas, what type of area it is in. Look at the crime rates in the specific areas. Look at the crossroads and, what separates different areas. Because like if you look at a neighborhood like Long Beach, for example, you have very, very, high-end properties in the very downtown by Ocean Boulevard, but, 10 streets up, it starts to become a suspect neighborhood, and you want to be very careful. So, and I'm being conservative by the 10th street thing, so it could be, even closer than that. So be very careful and analyze those neighborhoods in a lot of detail. Make sure you know how to do the rental analysis. You can go to different websites, but that's not always the best case. It's just a gauge to find out what the rents might be. But what does your property manager say? What do realtors say in the neighborhood? What does Craigslist say about that zip code and what things are renting for versus on the square footage analysis? So get your rental comps, very important. Renovation analysis, making sure all your roof, all of your electrical, all your major items are taken care of and allocated so that that way you know what things are done and what aren't. So, if you have an AC unit that's 7 or 8 years old or 10 years old, they usually last 15 years, sometimes more. So you want to start allocating money for a $3,500 cost for an AC unit within that period of time and take money out of your cash flow and put reserves aside for those types of issues that exist. Kitchens and bathrooms, very, very key and important. Doing a room by room and item by item analysis and doing a review of your inspection report with your contractor, very, very important. We get inspections on every single property that we do. And so we get this breakdown. This is just an example of an exterior breakdown that we did where we do the materials, the labor, the tax on each one of them and the totals for all of it on the exterior. So we break this down in a lot of detail when we're dealing with our renovations, and it's something to pay attention to so you know the costs of these different items that exist, so it's really, really important to understand these things. Market value analysis, understanding the recent sales, less than 6 months and a mile from the property is what appraisers usually use. Be careful about the highest comps in a declining market when you're flipping properties, especially. Appraisals is very much an art versus a science. You have to drive those comparable sales and understand what you're looking at when you're looking at the different neighborhood differences. Looking at from a cash flow perspective as well as a after repaired market value perspective. Okay, and looking at those appraisers' estimates and talking to an appraiser as well. Very, very key. So exit strategies. Whenever you're investing, know what your exit strategy is up front. So if you can buy and hold, fixing and flipping, refinancing the property, doing seller financing, all these are viable exit strategies when you're dealing with different investments. And then understanding the different negotiation points when you're buying a property as well. So can you get the closing costs paid for you? Can you understand what the rates are on the financing? Will the owner carry any financing? Any renovation credits that you see on the property? So there's a lot of different things that you can negotiate when you're actually going through and trying to invest in a specific asset, okay? Very, very key. This is one of the most important aspects, is understanding all of the costs involved. And these are the things that people don't necessarily realize when they're investing. So understanding the compiling all of your costs on your purchase side, and I can provide these different slides to you guys later on in PDF format. So if you guys want to look at them and kind of line out these different costs that are involved in your calculations, very, very key. One of the most important things I would say is don't ever forget about your profit and don't squeeze numbers to make a deal happen. Be very conservative on your numbers, and then if the deal happens, then great, but don't squeeze those numbers and fudge the market value and fudge what rehab should be and trying to be conservative. You're gonna go over on your costs if you do that, and it's not going to be profitable for you in the long run, and it will cost you some money. Let's look at the property acquisition flowchart. First, you get the property leads. Then you go and do the initial market value analysis and profitability analysis. Then you do your neighborhood and preliminary renovation analysis and your rental analysis. You start making offers and put things under contract at that point. And then you go back to your stuff again and reanalyze the property all over again once you get it under contract, doing the final bids, the profitability analysis, what exit strategies you have, and a backup exit strategy as well. What is the insurance inspections going to cost? Reanalyze that market value consistently during renovation and after renovation as well. Things may have changed in a couple months when you do your renovation. Then as soon as you're done with all that, and you can compile the information you need to line up the funding associated with it. And then you fund and close escrow on the property, and then you do the renovating and the tenanting of the property and resell the property, or have cash flow coming in like a fire hose, making it all look pretty for you. But it's not quite that simple. But at the same time, that's the basic gist of the entire kind of closing process. And so lining up the funding is important, and understanding before you even go through and put a property under contract, you want to be talking to investors about the funding in the first place on a project that you're working on and taking it out to clients. So before you close escrow, you want to analyze the title insurance, making sure that it's enough for you. Sometimes they'll only insure your purchase price, but if you're actually going through and doing a renovation on a project, they may go through and give you title on all of that as well. General liability insurance, understanding the vacancy period and the rental policies in place, and what perils are covered and not covered. Okay, is water damage covered? Is vandalism and theft covered? What do they give you as far as your loss of rents coverage? Look at your prorations on your taxes and understand that those are done correctly or not, and your rents as well. Proof of funds and funding, you have to be able to provide all that information. The HUD review, it does not cost $100 for a credit report on these different HUD closing statements for these lenders. It costs like $10 for a tri-merge. So make sure you're analyzing those, and you can definitely negotiate some of the costs associated with there from the attorneys as well as the lenders. Is the deed of trust correct? Review all the closing documents to make sure you understand those, and the earnest monies are credited. What about the keys? Who has the keys, and how do you get them after close of escrow? Understanding the renovation payments that need to be made if you're renovating the property, and understanding the promissory notes and lending documents is very, very key for your overall success. So let's talk about the key team members, especially for holding properties, is the property management aspect. Make sure you understand those contracts, all of their fees involved. What other things do they charge other than management fees? Do they charge for advertising costs? Do they charge repair markups? What are the different things that they charge? And can you understand their monthly accounting statements? Not all property managers are created equally. Sometimes their management statements are hard to understand, and maybe not in the format that you want them in for your best analysis. And I find that the cheapest manager is not always the best. Someone that's going to protect your asset, understands the tenant landlord laws in the state that they're doing business in, is very efficient on releasing properties and their leasing process, as well as their repairs and getting properties back up and running, is the key to a good property manager. And so interviewing managers in detail is very, very important. And the teams of rehabbers is important. I don't use one team. I use multiple teams involved. And these teams, what happens is the renovation time goes up, their costs go up, and their quality goes down if they know they're the only contractor involved here. So knowing those types of things and putting contracts in place on those different things, I think is very, very important, for that actual stuff. So, and I can email these PDFs to you later on. You just email me afterwards, and I can definitely give that to you. So now let's talk about some of the other team members. Brokers and bankers, very, very key. Private lenders, affiliates. Private lenders are very key, because how do you buy a property that's unrenovated and use a bank loan? It's not that easy. You have to have a private lender involved most of the time. Affiliates that can find properties and money for you. Insurance agents, CPAs, and attorneys in each market that you do business in. I don't pretend to know the laws in different states across the country. It's not for the state tax laws, even though I'm a CPA in California. You have to find someone that specializes in that state to help you structure your investments the best way you can. Inspectors are not all created equally. You want somebody that will go through the entire report with you at the same time as teach you what they think things cost, what issues may happen in the future for some of the things they find in the report. All very, very important team members to put in place. What about managing your overall investment? Very, very key. Once you own the property on a buy and hold property, you want to be able to manage this stuff. So, understanding what all your costs are on a monthly basis, your mortgage payments and taxes and insurance, and, is there a possible increase coming in those items? What is your property management costing you, whether it's management fees or inefficiencies? How much is a vacancy allowance are you putting in there, and is it close to budget? What are the other miscellaneous costs that come up that you're not thinking of that you want to be able to budget these things and know every month what is your true return on investment to date? What about the rental increases that occur? Are you making sure that on every single lease renewal you go through and say, hey, I'm going to increase rent by 2% or 1% or something along those lines? Managing the property managers, okay? Reviewing those monthly statements, you personally tracking your own collections is key because you want this managed the way you want it managed. If a tenant doesn't pay in the time frame that you want them to pay, then you need to be able to tell the management company, I want you to evict by the 20th of the month or by the 30th of the month or by the 6th of the next month if they miss the payments, or right away if they're not communicating with you at all and telling you they're going to bring in a payment and working out a payment plan. So these are all things that I think are very important when you're dealing with this stuff. Keeping up on those repair invoices, know what things actually were repaired already. You don't want multiple HVAC or heating unit repairs over and over and over again. Notifying your management about the procedures you want and telling them up front the way you want to be communicated with is very, very important to your overall success when you're owning property. And on quarterly basis, reviewing your numbers from the tax perspective, from the return on investment perspective, from the resale perspective, and what's happening in the market, and keeping your books up to date is very, very key for your overall success when you're investing in flips or holds. Very important. Okay. So how do we work with you? And I'll get into some other stuff as well. But just very briefly, investors make money with us investing in trust deeds. They invest with us by investing in joint ventures, or they buy property from us using bank financing or with seller financing. They go through, we do different syndicated investments that I invest in myself as well. We actually go through and deal with a lot of the tax structuring and bookkeeping support for our clients and help them with these different strategies. And we do real estate consulting and goal planning and things like that for our clients. And really, we find that most people don't necessarily realize all the resources that they have yet. So sit down with us and talk with us about the resources that you may think you have, and maybe we can find new resources that you don't even realize that you have. And it really comes down to slowly understanding and understanding financial education and knowing the different resources that can provide value to these different investment types. So I have a favorite quote by Robert Kiyosaki that says, one part of me is a hardcore capitalist who loves the idea of money making money. The other side of me is a socially responsible teacher who's deeply concerned with the lack of financial intelligence among society as a whole. And they don't teach this stuff in schools. It should be one of the most taught things that you can ever learn in school is financial education, balancing checkbooks, putting a budget together, understanding how investments and interests work, all very, very key to success. That being said, here's a couple of other investment options that we deal with. Here's a property that we have it's 1,800 square feet. It rents for $1,000 a month. The net rent's $619. If an investor wants to buy it from us with bank financing, it's $106,000, and they'll make about a 10% cash flow return on investment. It's about a $21,000 down payment, and a 16% overall return if you're including the principal reduction in the loan. And you can see the property pictures on the right. We fully renovated this property. If someone wants to buy it with cash, they'll make about $619 a month and about a 7% cash on cash return on their money buying all cash. If they're buying with seller financing, they're usually buying it for a couple $1,000s more, so I can build in some loan fees because I have to sell these notes off because I can't afford to be the lender on all of them. That's a lot of $54,000 loans going through. And so an investor can go put 50% down, and then they're having a monthly payment of $359 a month, and they're netting a $260 a month, which is about a 6.79% return on investment with seller financing. And that's a high rate, so at 7%. So someone later on can go refinance the property at a much lower rate and be in a better position on that aspect of things as far as a return goes. But I'm limited on what seller financing I can do. It's great for international clients that can't get US financing, or someone that's limited on their bank financing components. Here's another example of one of the single families, another 2,000 square foot house, fully renovated property as well, rents for $1,075 a month, same type of deal, 9.88% cash on cash return, or a 16% overall return on investment. We're looking at a cash purchase, the same deal, a 7% return. They're making about $8,000 a year on this investment. Seller financing, same type of deal as well as the last one. We're looking at about a 6.7% return on investment on that deal. Okay. In our property packages, this is what we do each time. We do the before and after pictures in the video, the property layout, a full disclosure checklist on the property with the age of everything, the inspection report with a side-by-side pictures of everything in the inspection report. We get a full rehab estimate, the disclosure checklist, as well, and financial projections. I realize I had a disclosure checklist on there twice. But this is the layouts we do. We have a software that we use for this. We actually do all of the comparable sales on the property, all of the comparable rent reports on the property. Here's our full disclosure checklist that we put together with the age of every single aspect of it, the roof, 5 years plus or minus years old, the furnace, air handler, condenser, water heater, plumbing, type, water shutoff if it has that, or where it's at, the electrical, all the appliances here, and the rents, and if they're current, and things like that on the property whenever we're actually selling or doing this for our own internal purposes. Here's a breakdown of a joint venture flip that we do, or a joint venture hold. So some investors choose to hold this long term, but I break down all of the costs for my clients. I don't care that they know all of my costs involved. If I'm reselling a property, I'm making about a 10% margin on the profits. If I'm holding a property, then I show all of my costs involved here, and you're looking at a breakdown of all of the costs that I've included, and there's benefits associated with holding these with the long-term capital gains. There's appreciation in the long run with that depreciation benefit. You have a good cash flow stream on our joint ventures. Having us as a team member can be very, very key and be very profitable, because we know we've done over 450 houses out in that market, and our cost is your cost on a joint venture. We don't make any money up front on these deals. And we also have bank financing that's available on these as well, where it'll be at our cost. An investor can come in, put 20% down at our cost, and we do a joint venture split with them on those deals. The joint venture flips, you have short-term profits. There's cash flow during the flip, because we buy it, renovate it, and tenant it, and then resell the property at that point. So it's cash flowing during the flip process. We always have the reinvestment capabilities afterwards, where we keep reinvesting the funds. And then, if there's a change in the market, then it's still producing cash flow on a monthly basis, and it's still a performing asset associated with it, with us, your team member, as well. Here's an example of one of those joint ventures with bank financing where it's at our cost. It's a 75-25 split on the cash flow and a 50-50 split on equity. So the investor gets 75% of the cash flow, we take 25%, and the OCG management fee is 8 to 10%, or 8% versus 10% to outside management. There's a 10% plus cash flow stream. Like I mentioned, the depreciation benefits and everything else, all the other benefits. The investor puts the down payment down and qualifies for the loan. OCG bought the property, renovated the property, tenanted the property, and brought existing equity to the table. So this is a 3,233 square foot house, 4-bedroom, 3-bath, built in '95, so hardly any preventative maintenance. It rents for $2,095 a month, and at a 4.75% interest rate amortized over 30 years on the deal, you're looking at about a $39,000 down payment, or $40,000 down payment on the deal, with an 8% rate of return or management fee. You're looking at about 11.8% cash on cash return after our 25% split is taken out. And then if you're dealing with the principal reduction on the loan as well, that's about a 14.89% return on investment for the investor on a really high-end asset like this in an amazing neighborhood. I mean, out in California, this thing would be a $2 million, $1 million house. It's crazy what you can buy out there for that, for the right pricing. Here's an example of a promissory note where an investor bought a property from me for $145,000 and put $85,000 down, and I loaned them the money for the rest. So investors can buy these notes from me. This one was at an 8% interest rate. So an investor bought it from me for $56,303 after there's been a couple payments on it, and they're going to make an 8% interest rate, which is $573 a month. And at the end of the balloon, at the end of the 7 years, there's a $41,000 balloon that gets paid on this deal. So very, very secure. It's at almost about 39% loan to value. So very, very safe investment type. Here's a couple of additional promissory notes. Investors typically make 6 to 8% on their money in promissory notes with us. There's a lot of equity protection. You don't have to deal with the headaches of the property. You can just invest with us on these investment types where it's all secured by the property at lower than market value. You know, this one on the left is a $105,000 property. It rents for $1,550 a month, and my payment on that is $700 a month. So I'm making a positive cash flow stream. That's a 5-year term. The other side, the 3462 Knight property, it's a 1-year term at 8%. So we have different ranges depending on investors' comfort level here. These are different investments that I personally invest in that I think is very, very key. And I know we're right near the end of the presentation. I just have a couple more slides and we should be good to go. But some of the really key things at the end I think will be really valuable for you guys. These different investment types are things that I personally invest in. I invest them through my own 401k plans and my own personal funds, where I put money into a commercial shopping center in Richmond, Texas, a 267 unit apartment building in Mesquite, Texas, a mobile home park fund where they buy mobile home parks throughout the United States, various commercial shopping centers in California, and a self-storage facility in North Carolina, retail shopping centers in Houston, Texas, other self-storage facilities in Florida, and a single family home flip fund that I did in the past, and a note fund. So these different investment types are all syndicated investments where you have a professional operator running it with like 15 to 20 years experience. And what happens is there's a preferred return, meaning the investors that invest in these projects, you know, there might be a $2 million capital raise and you can put in $25,000 to $50,000 and be a portion of that, that overall investment. And the investors get paid an 8 to 10% preferred return first before the operators make any money at all. So it's very aligned with the investor's interest. And usually you're looking at 8 to 10% cash flow returns with 14% plus overall expected returns and about a 7 to 10 year term on these investment types. So and these come up, you know, every couple months, a new type of deal comes up where we do criminal and financial background checks on the operators. We do a slew of due diligence before, you know, I personally invest or I go raise capital for these investment types. So, and it's a great way to diversify across different markets across the US, different asset classes, and have smaller chunks of cash put into these different types. So let's talk about what happens when we're learning all this stuff, whether you're investing yourself and trying to pull that trigger on that first, you know, that first flip or that first buy and hold property. You know, our worst fears really do shoot into our head, and we always have an excuse for what's happening. And, you know, a lot of times people go ask their relatives and people that they know about the investment in themselves. And, you know, all I have to really say for that is that you don't go ask your broke uncle or your broke relative financial advice when you may be doing better than they are. So you ask professionals that are in the field that can help you analyze these types of deals so you can gain the education to get over these types of fears. The only way to get over your fear of pulling that trigger is to educate yourself more and more as much as possible, and then honestly just pull the trigger and go buy something and flip it, or go buy a rental property and hold it and learn your lessons along the way. I'm telling you. And then the way to mitigate that is definitely to go through and talk with these professional investors that can help you. So, you know, we always have the fear of losing money, or, you know, what if you can't rent it, or there's a bad renovation, or the property goes down in value, or one of the biggest things is everyone's going to laugh at you, which if you're educated, you can kind of counterbalance those different problems that come up in people's heads with regard to what the risks truly are by going through and investing in the right market, getting a renovation guarantee, doing the right criminal and financial background check on the tenants involved, securing your money by the property and having the right insurance in place. And people kind of give up, some of the great benefits associated with this out of fear. And the benefits are really have a high probability case of happening as long as you've done your homework and done all your education up front. Then it's an amazing experience to be able to show other friends and family how to do this. I can't tell you the joy I get out of showing my family and friends and people that I know how this works, because it's the key to true financial freedom. And I know this with so much certainty. It's crazy that being able to share this with family, it's unbelievable. So let's talk about your next steps to financial success, okay? Whether you're working with us or working on your own, it's really important to understand these things and developing a strategic financial plan for yourself. And I just got this slide and one other slide and we're done. But this slide is very, very important to your success. Developing that strategic financial plan for yourself, okay? Assessing what your current assets, your liabilities, your income, and your expenses are every month. How do you know what your goal is without knowing what your starting point is and what your goal is as far as covering expenses on a monthly basis? Find ways of reducing your expenses. Look at every expense you have and try to find ways of reducing that. Your biggest expense is by far taxes. And so finding the right legal and tax structures in place to do those types of things and mitigate your liability is very, very key. And finding ways of increasing your income, either through passive cash flow, through flips. I don't care if it's starting an eBay business, go find ways of increasing your income outside of your job. Okay, because that type of income is 100% goes to you instead of your employers. Okay, setting the right financial and life goals for yourself. You have to have a written down, specific, clearly defined aim and goal in place, and really have a desire for its achievement. Now, you have to have a strong why. Why are you doing this? Are you doing this to show your kids how to do it? I have a 6-month-old kid, and I'm extremely excited to teach him financial education, to teach him how all these different things work. And my goal is developing a passive cash flow of $50,000 a month on passive income through buying multifamilies and buying single family homes over and over and over again, and working with different investors to do that. So I have a clearly defined written down goal, and you have to keep that in your head and constantly work towards achieving it. So, and getting educated, having the right financial education is the key through reading and audiobooks. We have different audiobooks, like I have Think and Grow Rich by Napoleon Hill. I have How to Win Friends and Influence People by Dale Carnegie. I have some amazing audiobooks you can ask us for, but this trains your mind daily, and writing down your affirmations saying, this is the way I'm going to live my life. This is the things I'm going to do on a daily basis to succeed at what my goals are. And these audiobooks and these books that you read consistently and habit forming to get that additional education is very, very important for your success in the long run. And it trains your mind how to think with the right mindset, okay? And taking action, you can learn everything in the world, but unless you take action on something, your knowledge is useless. It's not going anywhere. Successful people really work. I mean, it's amazing the things that I do sometimes to be able to succeed. I mean, when I was working for CPA firms, I thought working 60 hours a week sometimes during tax season was hard. Try working 75 to 80 on a tough week, it's pretty crazy, but I'm working towards acquiring properties that produce income, whether I'm working for them or not. So I'm acquiring these assets, and it's important to connect with the people with the same mindset. The people that have this type of mindset and are wealthy, talk about and think about different things than, the person that's, middle class or poor or not doing well. The middle class or the poor person might be talking about the next sports game, or what's going on and keeping up with the Kardashians or something like that. But the rich person, the person that you're trying to mastermind and work with and be around all the time, is going to be talking about that next deal that's coming up down the pike, or what's happening in the overall economy and some new opportunities that may be presenting themselves that you don't even know exist. Networking and finding new ways of making money with other people that you never knew existed is one of the best strategies and the best ways to really compound your exponential growth. And I really truly believe that the more you actually achieve in your life, and you're writing down your affirmations and slowly achieving your right habits, the happier you're going to be. Like, if you really go through and say, okay, every day I'm going to work out every single day, that first day you feel pretty amazing, right? And it's giving up that temporary satisfaction of sitting on the couch to get your butt to the gym and actually work out. But at the end of that workout, after you've given up that short-term satisfaction for that long-term satisfaction, you feel amazing. Now think about you going to the gym every day for an entire year and how unbelievably amazing that is. You're really giving up that short-term satisfaction for that long-term goal there, and the reward is always worth it at the end of the day. It really is, because you've achieved it and you have to want it. You really do. And so that being said, if you're going to actually go and try to invest in real estate and flip properties or hold properties, it's imperative to really, really focus on it on a consistent basis and not stop thinking about it. I can't tell you how many times my wife has told me to shut up about real estate investing. She's sick of hearing it. I'm telling you, it's great that I get to do these webinars, because you can see I'm going over budget or going over time on my time here. So that being said, we have a couple of great networking events coming up. My Phoebe Long Beach event, which a lot of you guys may know about. In January, we have a presentation coming up on, does your thinking limit your success? Very, very important topic. And our South Bay topic in Manhattan Beach on the politics of real estate. We'll have some different panels coming in there, and that's the second Tuesday of each month. This next one's on January 12th coming up. The Long Beach one's on January 28th. And then we have a holiday party coming up tomorrow on Thursday, December 10th. That is not going to be educational, but lots and lots of networking. That's at the Long Beach Grand Event Center, the same place that I have my Long Beach events. So feel free to go to that. It's 25 bucks. We don't really make any money. We're pretty much breaking even, if not losing a little bit of money on the event. We just like to get people there and network with other investors. So that being said, thank you guys very, very much for your time today. I will get back to some of the questions via email on some of these, and I can email them to you. But thank you for taking the time out. I appreciate it. Have a good rest of the night, and happy investing. Thank you guys very much for your time. Here's my email address at the top here at invest@ocgproperties.com if you'd like to email me for the slides or just talk about real estate or any questions you may have. If you need any consulting or are interested in investing with us, feel free to reach out to us, and I'd love to help you out. All right. Thank you.